Sometimes taxpayers or business owners, they will treat an asset an expense. But the IRS might say, no, this is not an expense. This is an asset. Okay? Hello, and thank you for tuning into this video. My name is Abdiwali Mohamed, and I'm a CPA, Certified Public Accountant, and a Master's of Science Federal Taxation holder based in Seattle, Washington. You are most likely here because the subject of this video might be an interest to you. I have been an accountant and a CPA for the last 18 years and counting. I meet many individual and business owners who want to take care of their personal financial needs, including their individual taxes, and business owners who want to start a new business. In the interest of time, we have divided this video into parts. There will be 6 parts. Now we're going to go to part 2, which is understanding classes of accounts. The reason why we divided these 2 parts is that we want to give you the option for you to skip to part 2, part 3, part 4, part 5, if you understand part 1. Some of you have an idea of what an S Corp is, what a C Corp is, but you might not have an idea when it comes to accounting. So you can skip to part 2 and stuff, or part 3 or part 4 as we go. So this is our part 2, understanding classes of accounts. So any businesses, when it comes to record keeping, your financial statements, you must have accounts, okay? And those accounts are tied to a financial statement. And the financial statements are, we're going to talk about that on part 3, by the way, but they're, as you can see, they're interconnected. So for example, a balance sheet, which is a part of a financial statement, needs to have accounts that are called assets, liabilities, owner's equity. An income statement or a profit and loss will need to have revenues and expenses. So these are the 5 accounts that we're going to be discussing the next several slides. Okay, so we're going to continue our 5 classes of accounts. So what's a balance sheet accounts? Balance sheet accounts are assets, liabilities, and owner equities. What are assets? Assets are things of value owned by the business, cash in the bank, building site that the business owns, vehicles, trucks, microphones, computers. These are all assets owned by the business entity. What's a liability? It's a debt that you owe to others. It can be the credit card company. It can be the wages that your employees have earned that you haven't paid yet. It can also be taxes that you have collected from your employees that you haven't furnished to the IRS or to the local agencies in your state. Examples also include the credit card in your wallet that you shop for your business, the bank loan that guarantees the loan of your business. And what's an owner's equity? Well, an owner's equity is the value of the assets that remain after all debts have been paid off, right? So you have cash in the bank, you paid your liabilities or debt. What's left over for you? Think of it as your savings, right? Well, sometimes you might have a liability and you might not have savings, right? Because you have an obligation to pay. So that's really what an owner's equity is. And by the way, these are just the general accounts. There is more sub-accounts in each account. For example, assets, you can have cash, building, inventory, and so liability, you can have payroll, notes, credit card, and stuff. Owner's equity, you can have retained earnings and common stock, those type of accounts and stuff. These are accounts that we cannot cover in here, but you will understand with your CPA or your accountant when you're reviewing your financial statements. We're going to continue our accounts. Now we are jumping to the income statement accounts. And this is the income statement. You probably heard profit and loss statement as well. So I'll be using these two words interchangeably. Income statement, profit and loss, they mean the same thing. We're now into income statements. Income statements or a profit and loss statement, I apologize if I use these two words interchangeably, but they mean the same. Profit and loss statement, income statement. And this is really an important document, especially when you are filing your taxes. As a sole proprietor, as a LLC, as a C Corp or S Corp, you will need this in order to prepare your taxes. So an income statement is usually made of two general big accounts. One is your revenues, and the second one is your expenses, right? What are revenues? Revenues are things that you earn. What are you selling? What service are you providing? It's the money that your customers are paying you, right? I'm a CPA. So when I prepare your taxes or when I prepare a financial statement for you, I'm providing services. And these are revenues. So I have to record them in my financial statements. What are expenses? These are outgoing things. Your employee wages, the rent, the office supplies, all those type of things are, your expenses. Cost of operating expenses. Examples include rent, salaries, electricity, water, advertising, and many more. And remember, each business is unique. One can have less than 10 lines. One can have 20. Think of a construction company. They're going to have multiple lines. But if you are a doctor or you're a dentist, you're probably going to have less than 10. Supplies, right? You have an employee, you have wages. You probably have rent and taxes. I'm just generalizing right now, okay? I don't mean 10, but you can have more than 10. But generally speaking, you can have 10. The bigger the business, the bigger the expenses, the more expenses you have to keep track of. The smaller the expenses, the less expenses that we align with. I'm gonna jump here to the slide called assets versus expenses. Sometimes taxpayers or business owners, they will treat an asset an expense. But the IRS might say, no, this is not an expense. This is an asset, okay? But you as a business owner, you're like, I bought something, therefore I have the right to write it off as an expenses. You are right. But guess what? There are certain rules you have to follow when it comes to writing off your expenses. Every tax season, people want to write off as many things as they can. There's nothing wrong with that. But there are certain things you cannot write off. You have to either depreciate them or amortize them, as we call them in the accounting language. So what's an asset? What's an expense? An asset is an item that contributes to the current operating year end and to the following year and after. Think of it as your building, right? When you buy a building, of course you paid money out of your bank, right? It reduced your cash, your cash flow, but you can't write off $5 million building. You have to depreciate that building, okay? On the other hand, if you're in the transportation industry and you own multiple trucks and each truck costs you $100,000, you cannot write off the truck for that whole year. There's a possibility you can. That's another day to discuss or discuss with your CPA. But I'm giving you general knowledge. It might take 5 years to write that off, okay? Expenses contribute only to the current operating year. For example, I went to Office Depot and I bought a printer cartridge. Well, I can have the printer cartridge for more than a year, but I can write that off because it's a printer cartridge. There is a printer behind me. I bought that printer for, say, $800. I can write that off. So think of it as, what do I need in order to operate the business? That's the expenses you can write off. There's a section in the IRS that I will reference later that will definitely help you understand. A good example is a repair of a broken bed. That's an expense. Purchasing new bed, for example, if you are in the healthcare industry or if you're an adult family home, if you buy an expensive bed, that costs $10,000 because the bed rolls forward and rolls backward or sideways, it's an asset. It's going to last more than a year. Does that make sense? I hope it does. We're now going to go to part 3, understanding financial statements.